If you observe the history of American financial markets carefully, you'll notice a pattern that is repeated for over 100 years. It's not a coincidence. It's not luck. It's mathematics applied to human nature. The Federal Reserve, the most powerful institution in the financial world, operates following predictable cycles. And when you understand these cycles, you don't try to fight them. You position yourself before they happen. We are now at a critical moment in this cycle. The decisions you make over the next 18 months will determine whether your next 10 years will be ones of prosperity or financial difficulty. Most people make the same mistake. They try to predict what the Fed will do tomorrow. This is impossible and unnecessary. What matters is understanding why they will do what they have always done throughout history. If you understand the incentives, you understand the behavior. And the Federal Reserve's incentives are clear. Maintain the stability of the American financial system, control inflation, and promote employment. When these objectives conflict, and they always do, they follow a hierarchy of priorities that history teaches us. The question you should ask is not, what will the Fed do in March? The correct question is, where will I be positioned when the next cycle completes? Because 2026 is not just a year on the calendar. It's the moment when various economic forces already in motion will converge in a way that will fundamentally change the financial environment for the next decade. History is an excellent teacher, especially when it comes to monetary policy. Since the creation of the Federal Reserve in 1913, monetary policy cycles have followed a pattern that reflects human nature itself: expansion, excess, correction, and reset. In the 1,920 seconds, the Fed maintained an extremely accommodative monetary policy. Cheap money fueled rampant speculation. Everyone was making money. The illusion was that this time is different. It wasn't. When reality hit 1929, the Fed initially tried to keep rates low to save the economy. They realized too late that the problem wasn't liquidity, it was excessive leverage and capital misallocation. In the 1,970 seconds, the Fed again chose monetary ease to combat consecutive recessions. The result? Double-digit inflation and the destruction of the dollar's purchasing power. Paul Volcker took over in 1979 and did what needed to be done. Raised interest rates to levels that many considered impossible at the time. Over 20%. The economy entered a severe recession, but inflation was tamed. After the dot-com crisis, the Fed reduced rates to 1%. This fueled the housing bubble. When it exploded in 2008, the response was even more stimulus, rates near zero, and unprecedented bond-buying programs. Each cycle teaches the same lesson. Excessively accommodative monetary policy always creates imbalances, and imbalances always correct themselves with or without the participation of authorities. If you draw a line through these cycles, you'll see that each Fed response to a crisis creates the conditions for the next crisis. Not due to incompetence, but because political and economic incentives push authorities toward choices that seem right in the short term, but create long-term problems. It's a mathematical pattern based on human nature. Now we're at the end of another one of these cycles. And 2026 represents the moment when the consequences of policies adopted since 2020 will become inescapable. To understand why 2026 is crucial, we need to comprehend three fundamental principles that govern monetary policy. The first is the debt dilemma. When a country or an economic system has too much debt, its options are dramatically reduced. Total American debt, government, companies, and families, today represents more than 350% of GDP. This is not sustainable indefinitely, but it also cannot be corrected quickly without causing a severe recession. The Fed is trapped. If it keeps rates too low for too long, it creates inflation and asset bubbles. If it raises rates too quickly, it breaks the financial system due to the weight of existing debt. This is the central dilemma that will define all decisions in the coming years. The second principle is the mathematics of credit cycles. Credit expands and contracts in predictable cycles. When credit expands, people feel rich and spend more than they earn. When it contracts, they feel poor and spend less than they earn. We've been in a credit expansion cycle since 2009. Low rates created an illusion of wealth through inflated asset prices. People refinanced homes. Companies took loans to buy back shares. Governments expanded spending. But every credit expansion finds physical limits. And we're approaching those limits. The third principle is the hierarchy of priorities. When forced to choose, the Fed always prioritizes first the stability of the financial system, then inflation control, and lastly, employment maintenance. This means that if inflation threatens the dollar's credibility as a global reserve currency, the Fed will choose a recession to preserve the monetary system. If the banking system is at risk, the Fed will print money even if it causes inflation. Understanding this hierarchy allows predicting future actions with high probability. Why is 2026 special? Because several forces converge in this period. The American political cycle with midterm elections, the maturity of trillions in government bonds that will need refinancing, the end of the transition period post-pandemic in the global economy, and the maturation of effects from policies adopted between 2020 to 2024. This isn't a prediction. It's a logical consequence of decisions already made and forces already in motion. To understand how these principles work in practice, imagine a family that for 5 years had access to cheap credit. They bought a bigger house, financed a new car, used credit cards for travel. While interest rates remained low, everything worked. The house appreciated, salary increased modestly, they could pay minimum installments. Now rates have risen, the house value has stagnated, the credit card that cost 2% per month now costs 4% per month. They need to choose cut spending drastically or default. This family represents millions of Americans today. Similarly, a technology company took advantage of low rates to borrow money and buy back its own shares. For years, this worked perfectly. Shares rose, executives earned bonuses based on stock performance, investors were happy, but the company didn't invest in new products or markets. It used borrowed money to create the illusion of growth through financial engineering. Now it needs to refinance debt at much higher rates. And it discovered that without real revenue growth, it can't pay either principal or interest. This company represents thousands of American corporations. The American government borrowed trillions of dollars during the pandemic. Part was necessary support programs during lockdowns. Part was political programs that seemed good in the short term. Today, federal debt service already consumes more than 15% of all revenue, and this with historically low interest rates. If rates normalize to historical levels of 6 to 8%, debt service could consume 30% or more of the budget. This will force impossible choices: drastic cuts to popular programs or significant tax increases. Both options are politically toxic. These three scenarios aren't independent. When families cut spending, companies sell less. When companies lay off workers, families have less income. When the government raises taxes or cuts spending, both families and companies are affected. It's a self-feeding cycle, and the Fed is at the center of all this, trying to balance forces that naturally want to unbalance. Imagine two neighbors in 2025. John noticed the pattern. Over the past 2 years, he paid off credit card debt, fixed his mortgage rate, diversified investments across different asset classes, maintains an emergency cash reserve, and learns skills that make him more valuable in the job market. Peter believed that rates will return to zero and that the Fed always saves the economy. He kept variable debt, concentrated investments in growth stocks, has no significant reserves, and believes his job is secure because it always has been. When 2026 arrives, Peter will discover that neither the Fed nor the government can save him from the consequences of poor individual decisions. John will be positioned not just to survive, but to thrive during the transition. How does this affect the average American thinking about retirement, wealth protection, and financial security? For those close to retirement, between 55 and 65 years old, you don't have time to recover significant losses. Your priority should be capital preservation, not aggressive growth. The most common mistake in this age range is assuming that the last 15 years of continuous bull market represent the new normal. They don't. You should reduce exposure to risk assets like growth stocks, cryptocurrencies, and speculative real estate. Increase positions in assets that benefit from higher rates like shorter-term bonds and CDs. Consider part of your wealth in tangible assets like well-located real estate and commodities. Maintain sufficient liquidity for 2 to 3 years of expenses. For those with 10 to 20 years until retirement, between 40 and 55 years old, you have time to navigate cycles, but you can't ignore the reality of the coming years. Your strategy should be building resilience while maintaining growth potential. Balance investments between growth and protection. Consider sectors that benefit from inflation like energy, agriculture, and infrastructure. Develop multiple income sources. Invest in your own education and skills. Pay off consumer debt quickly. Families with young children between 30 and 45 years old will face the greatest challenges. Rising educational costs during a period of likely wage stagnation. Early planning is crucial. Prioritize financial education for yourself and your children. Invest in assets that historically preserve value during transitions. Education, skills, relationships. Consider more efficient alternative educational models. Build resilient local communities. Young professionals between 20 and 35 years old have the advantage of time, but will also face a transforming job market. Adaptability will be more valuable than stability. Develop skills that can't be easily automated. Learn about finance and investing early. Consider entrepreneurship as a complement to traditional employment. Invest heavily in relationships and professional networks. Regardless of age, some principles apply universally. Liquidity is king during transitions. Keep more money available than you normally would. Opportunities appear during crises, but only for those who have available capital. Real diversification, not cosmetic. Having 10 different stock funds isn't diversification. It's disguised concentration. Real diversification means financial and tangible assets, different currencies, different geographies, sectors that respond differently to inflation. Recurring income before capital gains. During transitions, predictable cash flow is worth more than the possibility of extraordinary gains. Prioritize investments that pay dividends, rent, royalties, or other forms of regular income. Relationships are assets. During economic crises, who you know can be more important than how much you have. Invest time building genuine relationships in your community, industry, and family. To position yourself before 2026 arrives, follow this timeline. During the first half of 2025, establish your foundation. Make a complete inventory of your financial situation. Identify and pay off high-cost debt, like credit cards and personal loans. Build an emergency reserve equivalent to 6 to 12 months of essential expenses. Renegotiate or fix variable rates when possible. In the second half of 2025, focus on positioning. Geographically diversify part of your investments. Consider commodities as protection against inflation. Reduce exposure to sectors dependent on cheap credit, like speculative technology and commercial real estate. Increase positions in defensive sectors like utilities, essential consumer goods, and healthcare. During the first half of 2026, make final preparations. Maintain high liquidity to take advantage of opportunities. Monitor stress indicators in the financial system. Have alternative plans for different scenarios. Strengthen personal and professional support networks. Monitor early warning signs. Yield curve inverted for more than 12 consecutive months. Sudden increase in corporate credit spreads. Significant drop in bank credit origination. Growing volatility in government bond markets. Watch for opportunity signals. Drops of 30% or more in stock indices over short periods. Significant increase in quality corporate bond yields. Availability of real assets like real estate and companies at discounted prices. Emergence of new technologies or business models during crisis. Consider 3 possible scenarios. The first, with 30% probability, is a soft landing where the Fed manages to reduce inflation without causing severe recession. In this case, maintain a balanced portfolio. Take advantage of volatility to rebalance periodically and focus on companies with resilient business models. The second, with 50% probability, is a moderate recession where the economy enters recession for 12 to 18 months, but the financial system remains stable. Here, prioritize quality over growth, maintain liquidity to buy during drops, and consider medium-term government bonds. The third, with 20% probability, is a systemic crisis where multiple financial institutions face problems requiring massive government intervention. In this scenario, liquidity and tangible assets become crucial. Exceptional opportunities appear for those who are prepared, and the focus should be survival first, growth second. Avoid common mistakes. Don't try to time the market perfectly. No one can predict exact timing. Focus on being adequately positioned for different scenarios. Don't follow the crowd. When everyone is doing the same thing, it's probably too late to profit from that strategy. Don't ignore politics. Economic decisions are also political decisions. Understand politicians' incentives, not just economists. Avoid excessive complexity. Simple and robust strategies work better during crises than sophisticated strategies that depend on specific conditions. Don't suffer from analysis paralysis. Having 80% certainty and acting is better than having 100% certainty and missing the timing. If you've made it this far, you already understand something most people don't comprehend. Financial markets aren't casinos. They're complex systems governed by mathematical principles and predictable human behavior. The Federal Reserve isn't omnipotent. They operate within physical and political limitations that restrict their options. When you understand these limitations, you stop trying to guess what they'll do and start preparing for what they can do. 2026 won't be the end of the world. It will be the end of one cycle and the beginning of another. Cycles always end. The question isn't if, but when and how you'll be positioned when it happens. History teaches us that great wealth transfers happen during transitions. Wealth isn't destroyed, it's transferred. From those who weren't prepared to those who were, from those who fought against economic forces to those who aligned with them. It's not about being pessimistic or optimistic. It's about being realistic. The reality is that we live in an economic system based on debt and growth. When growth slows and debt becomes unsustainable, adjustments happen. These adjustments are painful, but they also create opportunities. If you observe carefully, you'll see that we're living through the end of one of the greatest monetary experiments in human history. 40 years of constantly declining interest rates created enormous distortions in capital allocation. These distortions need to be corrected. The correction can happen gradually and controlled, or suddenly and chaotically. The Fed would prefer the first option, but won't always be able to choose. Your responsibility isn't to hope the system works. Your responsibility is to be prepared for any outcome. Remember, the difference between those who thrive and those who merely survive during transitions isn't in luck or superior intelligence. It's in preparation, discipline, and understanding of timeless principles. The coming years will test your ability to make rational decisions under emotional pressure. When others are in panic or euphoria, you'll need to stay calm and follow your principles. This is the real test of an investor, not your ability to make money when everything is easy, but your ability to preserve and position capital when conditions change. History is full of people who understood cycles and positioned themselves adequately. They weren't smarter than others. They simply paid attention to patterns that always repeat. The pattern is repeating now. The only question is, are you paying attention? 2026 isn't just a year. It's an opportunity to demonstrate whether you've learned from history or are destined to repeat it. The choice, as always, is yours. But remember, not fighting the Fed doesn't mean agreeing with everything they do. It means understanding that they're a force of economic nature, like gravity or tides. You don't fight gravity, you work with it. Similarly, you don't fight economic cycles. You position yourself for them. And when the next cycle begins, and it always begins, you'll be ready